2025 is now behind us. And if you're a business owner, there are several tax decisions that had to be made by December 31st. Decisions that, if handled correctly, could have saved you a significant amount of money. What I want to do in this video is walk you through the most important year-end tax strategies for business owners. These are the moves I see come up over and over again in real life. Things that are often missed, delayed, or misunderstood until it's too late. I'm also going to be releasing a separate video that focuses specifically on year-end tax strategies for individuals. So make sure you check that out as well if that applies to you. For those of you who don't know me, I'm John Harmon with Harmon CPAs and Associates. Our firm works with business owners to help them save money on taxes, stay compliant, and reduce the stress that tends to build up around tax season. Strategies we're going to talk about today are things that should be evaluated at the end of the year. But just as importantly, they should be reviewed again at the beginning of the new year, while you still have time to make adjustments. Let's get into it. The first thing every business owner needs to focus on is getting their books cleaned up. Let's be honest, most people don't enjoy bookkeeping. It's not why you started your business. But once you get to the end of the year, this isn't optional anymore. This is a foundation for everything else we're going to talk about. The reason this matters is simple. If your books aren't accurate and up to date, we can't properly prepare your tax return. And when bookkeeping drags on too long, what I usually see is deadlines getting missed. And that's when penalties and interest start to show up. The goal here is to avoid all of that. When your books are clean, everything else becomes easier. Second area business owners should be looking at is retirement contributions. One of the most powerful tools we use in the right situations is a defined benefit plan. When structured properly, a defined benefit plan can create very large deductions, often in the range of $100,000 to $300,000 per year. The earlier a defined benefit plan is established, the more flexibility you typically have, and the larger the potential deduction can be. Waiting until year end often limits what can be done. The third area I want business owners to pay close attention to is contractor payments and 1099 compliance. If you paid contractors during 2025, one of the first things you should confirm is that you have a signed W-9 on file for each contractor you pay more than $600. Those 1099s have to be filed by January 31st of 2026. When it's missed, penalties can apply. The best approach here is simple. Get organized early. The fourth area to review is employee bonuses and tax-favored perks. If you plan on paying bonuses, timing matters. Bonuses have to be paid before December 31st in order to be deductible on your 2025 return. Waiting until after year end means the deduction moves to the following year. Beyond bonuses, there are also tax-favored perks that many business owners overlook. Certain benefits, like company-provided cell phones, educational assistance, or small employee gifts, can be deductible for the business while often being tax-free to the employee. When these benefits are set up correctly, you're rewarding employees in a way that's efficient for both sides. The fifth strategy is something known as the Augusta Rule. This rule allows you to rent your personal residence to your business for up to 14 days per year. The business receives a deduction, and the rental income you receive personally is tax-free. There are specific requirements and rules that all need to be followed in order for this to hold up. So if this is a strategy you're considering, make sure you understand the rules and have the documentation in place before using it. Number 6 applies specifically to S corporation owners, and it has to do with health insurance. This is an area where I see mistakes every single year. S corporation business owners can deduct the health insurance by paying those premiums through the business, and they need to be run through payroll so they show up correctly on your W-2. If that step is missed, the deduction doesn't work the way most people expect it to. The good news is If this hasn't been accounted for yet, there's often still time to fix it before year end. The seventh strategy applies to businesses that use the cash method of accounting, which is most small and mid-sized businesses. Under the cash method, income and expenses are generally reported based on what actually hits the bank. What comes in is income. What goes out is an expense. That's why prepaying certain expenses before year end can be effective. When you prepay items like rent, utilities, insurance, or advertising, you're accelerating those deductions into 2025. The result is a lower taxable income and potentially a lower tax bill for that year. The eighth strategy is closely related to the last one, but it works on the income side instead of the expense side. In some situations, if a customer is scheduled to pay you near the end of the year, you may be able to defer that payment until early January. By doing that, the income shifts from 2025 into 2026, which can reduce your taxable income for 2025. Just like prepaying expenses, this isn't about avoiding taxes. It's about managing when income is recognized. The income doesn't disappear, it simply moves into the following year. Number 9 is purchasing equipment or vehicles. When a business purchases qualifying equipment, things like computers, machinery, office equipment, or vehicles, you may be able to deduct a large portion, or in some cases all, of the purchase price in the year the asset is placed into service. When done correctly, these purchases can create significant deductions on your 2025 return. Number 10 is making a pass-through entity tax payment, often referred to as the PTET. Certain pass-through entities can receive a fully deductible business expense at the federal level. This is generally available to S corporations, partnerships, and LLCs taxed as partnerships. But, and this part is critical, the rules are entirely state-specific. If you haven't looked into PTET yet, this is one of the higher impact strategies worth reviewing before year end or very early in the new year. Number 11 is hiring family members into your business. The work has to be legitimate, the pay has to be reasonable, and everything needs to be properly documented. For example, hiring your children can, in certain situations, allow income to be shifted into a lower tax bracket. That compensation may be taxed at very low rates or potentially not taxed at all. Number 12 applies specifically to S corporation owners, and it has to do with how you pay yourself. The amount you pay yourself matters. Your compensation has to be reasonable. That's the baseline. Your salary affects more than just payroll taxes, and it influences multiple parts of your tax return at the same time. This is why S Corp compensation isn't something you want to set once and forget. It should be reviewed each year. Number 13 is about looking ahead into 2026 and reviewing your entity structure. This is where we step back and ask a bigger picture question. Does your current business structure still make sense from a tax perspective? For many business owners, that means evaluating whether an S corporation election could reduce taxes going forward. At a high level, S corporations often start to make sense once a business is consistently netting somewhere in the range of $50,000 to $100,000 or more. It's a common threshold we see in practice. The reason this review matters now is timing. If an S corporation election is going to make sense, it often needs to be in place as of January 1st to maximize the benefit for the year. So this isn't just about how you file this year, it's about setting yourself up correctly going forward. These strategies can make a meaningful difference in how much you pay in taxes and how smoothly 2026 starts. The key is planning early, because the sooner you review these items, the more control you have over the outcome. If you're a business owner looking for proactive tax planning, you can request a strategy call using the link below. We use a short questionnaire to make sure this is a good fit for both sides. Please like this video and share this to someone who can take away some key points from this video. Please follow my LinkedIn for more content. The link is in the description.